Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted again to be able to speak to Jamie Constable of Singers, a top-notch capital markets expert. So welcome, Jamie.
Hi, Paul. Great to see you again.
Yeah, well, the big news last week was the lower than expected US payrolls report, but that didn't seem to deter the bond vigilantes, pushing the yield on the 10-year Treasury to 1.6%. And there was even a former US Treasury Secretary saying the yield's going to hit 3.5% sometime going forward. So what's your sort of latest view of the for the 10-year Treasury at the end of 2021 and 2022?
I think we move back towards that 2% level for 2021. And it does, 2022 is a long way, end of 2022 is a long way out, but I think it will still be rising because we're going to see inflation. Arguably, the central banks maybe have got a bit behind the curve. Certainly, when we come back to the UK, we can talk about that. But yeah, I think 2.5% probably. 3.5% is right out in terms of the expectations, but it's the direction that counts, isn't it?
Yeah. And what about the UK with gilts and stuff? How do you see that one sort of panning out? Because we're now at a 52-week high of 1.2%, and that seems to be accelerating actually on the up. We can see that coming through on the major banks. Yeah.
Well, the banks, after being kind of anathema to the market, no one's really interested in investing in banks. The last few weeks, they've been actually performing quite nicely again.
Yeah.
Well, for the first time for years, almost, to be fair. So I think on gilts, I could see you getting to 1.5% by the end of the year. The Bank of England are telling us it's going to be 4% inflation by the end of the year.
And in 2021?
Yeah. And then you're going to probably, with the energy prices doing what they're doing, you could hit 6, people are saying, by the spring.
Yeah.
Well, they're not going to be. So I think 1.5% at the end of this year and 2% by the end of next is probably being quite conservative from that point of view. But it's the direction that counts again, really. Yields are going up.
Yeah. And given the economies are so dependent on the health of the consumer, how's that going to sort of pan out? Because if rates are going up, then sort of like the cost of mortgages will be rising. The likes of car loans will also be rising. Inflation will hit certain people, like, if you're a working family and your salary is going up by at least inflation, you're probably okay. But if you're a household on universal credits and haven't got any income coming in, then you're probably going to be struggling. How's your view on the sort of the consumer, which is really 60-70% of the UK and the US economy?
It is. Services are 80% of the UK economy and not far off. It's a bit less in the US.
Yeah.
I think what we really need to watch, and I know you like that to say, what should we watch in the month ahead? Confidence is going to be it's the key thing to watch. At the moment, we've got a supply chain shock, which we talked a lot about last time.
Yeah.
Its confidence is going to be key as to whether that hopefully doesn't turn into a demand shock. So what does it mean for the consumer? Back to your original question, you've got these twin pincer movement at the moment, which is, it's hard to see which way we're going to come out at the moment. On the one side, you've had jobs numbers today in the UK. We're back to pre-pandemic levels of people in employment. There's a record number of vacancies, 1.2 million vacancies. That's obviously all very positive. People are in jobs, they've got money to spend, and they've got a 200 billion, don't forget, of pandemic savings as well. On the other side of it, you're quite correct. You've got energy prices, you've got food prices, you've got just energy. Look at the fuel prices. If you can find petrol, which you can now, of course, but you've got fuel prices going up. That's all squeezing the consumer. And don't forget, from April next year, national insurance goes up as well. So you've got these twin pincer movements, and the equity market is kind of struggling with that a bit at the moment to kind of work out which way we go. For me, it means you want to stick with the quality companies, really. Stick with the quality companies, the management that can manage their way through it, the management experience of managing these massive number of inputs they're having to deal with at the moment, impacting on their business.
Yeah. And it seems as though with the consumers, so you've got two sort of like major sort of parts of the consumer ecosystem. You've got the people in work with salaries rising at sort of like 4 or 5% underlying, which should be able to give you a real positive return, sort of like a wage increase. But for people, say, who are not in work, the 5 million households on universal credit, they're going to obviously find it difficult just paying rent and the energy. And I could actually see Rishi Sunak increasing the the benefits to those people in the short term if it causes a problem. Would that seem sensible? Or
I think there's talk the living wage. There's talk that the living wage is going to be raised. So I think we will probably see that again. Normally they raise that from April. So the living wage will rise. Obviously, rising wages are good for the government because if you've got full employment, which arguably we're moving towards on that. We are moving towards that. Well, of course, taking your point about the unemployed into account there. But if you've got full employment and you raise and wages are rising, your tax take rises, which is what the government needs at the moment. It needs more tax revenues coming in. So net, I think it's positive for the economy. Of course, if wages get out of hand, then that's when we can get into the inflation spiral. And that's when you have the problem with confidence. And then if confidence gets hit, demand side gets hit. And that's when you have problems in the economy. But you have got people who have unfortunately haven't got jobs. But there's 1.2 million vacancies out there, Paul. I mean, there's plenty of jobs out there. Apparently there was short 1 million people on furlough, but coming to the end of the scheme at the end of September. But there haven't been notifications of big redundancies. I don't know. I haven't seen any. All I've seen is companies coming out saying we need 10,000 people for Christmas or 5,000 people here, etc. So I think there's plenty of jobs out there for the people who want to work. We've got, as I said a minute ago, we've got more people working now than we had pre-pandemic. And let's be honest, the economy was in a reasonable state, a pretty good state there. So for the economy as a whole, in terms of consumer spending, the outlook looks pretty good, doesn't it? I mean, and it comes back to the point I just made. It comes back to confidence. Do people want to spend the money? Yeah,
no, I'm with you. I still think there's a good and positive and sort of like a favourable outlook on the consumer side. And if we're right, and let's hope we are, for the country's sake. It seems as though there's a slight sort of like contradiction on the markets, because many of the consumer stocks have been absolutely hammered, particularly the ones which have been considered as COVID beneficiaries. So your likes of Boohoo and Warpaint and the Hut Group, and also ASOS yesterday got absolutely hammered as well. So what's your view on that sort of ecosystem? Because they're really cheap now, those companies.
I think what's hit them, I mean, ASOS isn't a favourite of mine, to be honest. I mean, my long-standing bear view on ASOS that they don't earn the margin that something like a Boohoo can earn. And part of the reason behind that is that half of what they sell is branded clothes. The problem on branded clothes is you don't have any pricing power. Someone can sell it somewhere else on the web. The difference with Boohoo is it's all their own clothes, it's all their own designs, and also they're very good with their test and repeat model. So that's why they earn double the margins of ASOS. So when you see the squeeze, and what squeezed these companies, ASOS in particular and Boohoo as well, is freight costs, and it's the cost of returns and the cost of sending goods out to people. So what we really need to watch there is what happens to freight costs going forward. Now, freight costs come in two ways. It's shipping the goods in the first place, but then shipping them out to the consumer. So it's quite interesting container rates. And in terms of what to watch in the next month, confidence is one issue thing. The second one I want to watch over the next month is container rates. The Shanghai Los Angeles rate has already dropped by 10% off its high. Now, obviously for Europe, the important figure is Shanghai to Rotterdam. That hasn't rolled over yet. But if you think about what's happening in China, I mean, the energy crisis, I'm sure we're going to come on to in a minute, but that's hitting China as well. So a lot of the industrial parts of China are running at 4-day weeks when they normally do 6-day weeks. Well, that means that at the least, there's only 2/3 and probably less than that of goods to be shipped. So what does that mean for containers? Well, the actual shortage of containers should roll over relatively quickly on that rate, shouldn't it? Because you're shipping 2/3 of what you were shipping before. So if the rates come back, I'm sure those container rates will then wash over into the kind of more localized rates, the likes of ASOS and Boohoo, etc., spend for shipping their goods and bringing them back. So you've got fuel prices on the other side of it, of course, but once you see those container rates coming back, I think that's probably a good buy signal for these stocks. And we've got the first inklings of it with that Shanghai to LA rate coming off 10%.
And also Boohoo have got more sort of like assembly or manufacturing in the UK, haven't they?
They have, which obviously hurt.
Exactly, yeah.
But if you think about, and people go on about the Chinese manufacturer whose name I've just forgotten, let's say anyway, as a competitor. But let's be honest, this is a huge space, plenty of room for everybody. And the one thing about Boohoo is the amount of work they have done on the ESG equation is huge. So it'd be hard, I think, for someone to be ahead of them in terms of ESG now. So as the demand comes back, well, as the cost side, it's not the demand comes back, the demand is there. We're not talking about a demand problem in the global economy. We're talking about a supply issue and cost issue. As the cost issue fades, people are going to want to buy these stocks. And you can buy Boohoo now on 13 times PE for March 2022 earnings. I mean, 13 times?
Yeah.
I mean,
yeah. And I mean, I ran the actual numbers, and given their sales are going to be at sort of 2.1 billion this year, or that there and thereabouts, and their growth rate, they're still indicating second half they're going to sort of like do a growth of roughly between 20 to 30%, sort of like organic growth. And then if you push that sort of forward 5 years, you get to 5 billion, sort of in sales. And if you use a sort of 10% EBITDA margin, which is what they're indicating going forward, then you get and you put a market multiple of 20 times on it, you get a share price of over £8. And if you did a 10 times EBITDA multiple, you get over £4. So I'm with you, it does look extremely cheap for a high quality stock. And I think the CEO, John Little, is doing a terrific job and got unfairly hit at the interims, because he's doing exactly the right thing. He's putting automation in. He's expanding.
Well, he's got the benefits of the automation in the price in the forecast yet either. So I totally agree. And I'd buy Boohoo over ASOS every day. That's the one I'd want.
And another one on the actual cosmetic side. I mean, I know you know quite a bit about Warpaint, don't you?
Yeah, we're brokers to Warpaint. I mean, this is about the consumer and how much money they've got to spend. The thing about Warpaint and Revolution Beauty and the Hut Group to a degree as well, the Hut Group's more kind of at the luxury end, I suppose, with the kind of cosmetics they do, but they do the whole range. But with Warpaint and with Revolution is that they are kind of in the own brand, it's W7 for Warpaint, own brand cosmetics. And what Warpaint are doing is they're basically getting into more and more outlets. So Boots in the UK, multi-channel outlets in the US, and the consumer wants to buy this. So it's just kind of, they're in a great position at the moment. They're coming from this position where they didn't really do online, so they're doing a bit of online direct sales as well. But there's nothing really in the price for that. So yeah, they're in a good part of the market. And it's always easy to forget that the largest part of the market is the mass market.
Yeah. And
that means there's huge demand out there. So for companies like that going into that market, it should be they've got a following wind. So
no, I mean, I've run the numbers over Revolution Beauty, and at the sort of like the trading update of the half year, Adam Minto, the founder and CEO, put out like-for-like sale increase of 35%, and actually that's what his shares went down by. I mean, it's been absolutely crazy. It's been totally counter-logical, and I know if you sort of like you run the numbers on that and put normal sort of like margins and multiples on it, you get a share price of sort of well over £4 compared to sort of £1. I think it's sort of like £1.30 or £1.40 at the moment. And you can if you put, I mean, Adam's got a very aggressive sort of long-term estimate and wants to get to £1 billion in sales in 5 years' time, which, given where he's come from a standing start from nothing in 2014 to reach 200 million sales, I wouldn't sort of like bet against him either. If he hits that, then the shares go well over £10. So there's plenty of upside for these things, and they're basically challenger cosmetics brands, supplying high quality cosmetics and beauty and hair care and skin care products at a very, very affordable prices. I know Revolution Beauty have got into ultra beauty out in the States, and Target, they're the #1 cosmetics brand in Target, which just shows you how popular they are. And I think they've just increased the ones on in Boots as well. So good. I mean, I think we're both reaching the same sort of same conclusion. The underlying picture for the consumer is actually healthy, and if there is a problem in terms of the people who haven't got salaries, i.e. the households on universal credit, I actually think there's a good chance the government will dip into its pockets and help people out through that, because
leveling up. If you believe the leveling up agenda, wages going up, then it should be all good for those. I mean, the market's been very undiscriminatory. It's hit everything really in the retail space over the last month since we last. So stocks like Joules have come back a long way, and they've been a massive.
Ben Brown's another one to have a look at.
Studio. I mean, all these stocks have been hit. So I think there's some good value in that space, definitely.
Yeah. The other big sort of like topic du jour is obviously the whole energy complex now that has really run quite well this year on a year-to-date basis. But actually, if you look at it over a 5-year context, it's still well below it's well below it was 5 years ago. Never mind its 5-year highs. And so should we, if we ever sort of pick through some opportunities there, because I did see a lot of the very popular hedge funds going into oil and gas and doing very well, like Crispin on and there was lots of
very well.
hedge. Yeah. So what's your view on the sort of the oil and gas sector first of all? Because we've got the integrated oils, we've got the pure plays in gas, we've got the oil services businesses out there. So, and what's your sort of view? Say, I mean, let's start with Shell, BP, Exxon, and Chevron.
I think just a very quick overview of where we've come from, I think is interesting first. I mean, if you think back, we're at -37 oil.
And that was I think that was sort of like the 24th of April, wasn't it? 2020. So I remember the date.
Yeah, -37 oil, and now we're at $80 on WTI and Brent.
Yeah.
I mean, my view was, with renewables, we'd see declining highs, i.e. they'd bounce, but you get declining highs.
Yeah.
I think I'm slightly changing that a bit now, to be honest, because what we're seeing is that does renewables mean that oil and gas prices stay higher for a lot longer? Because it's all about supply and demand again, isn't it? If they're not exploring these people because they're being discouraged from exploring for more oil or more gas, well, there's no new oil and gas coming onto the market. So as reserves deplete, then the price will stay high. So maybe we see the price staying higher for longer. And if you think about Shell and BP, at $80 oil and whatever price of gas we've got today, I mean, it's all over the place, but they're going to be delivering prodigious amounts of cash. Now, you also need to remember that Shell and BP are quite good renewables players as well, because they're investing huge sums into hydrogen, etc., whatever. So they have the cash flow to be able to invest in renewables. So they're still high-yielding stocks, even though they've bounced. But as a part of a portfolio, I think you have to consider them really, because it's not going to go away. We've all see what's happened with the price of oil. OPEC, rightly or wrongly, control the oil demand or supply in the world. Putin, to a degree, decides how much gas we have.
In Europe,
obviously not totally, but does. Yeah, I mean, maybe the price stays high, so you can't ignore these stocks. And as I say,
just on a valuation, I mean, even though the Shell and BP have increased of late, they're still trading on 8 or 9 times PE with a 4 to 5% dividend yield. So, and actually, the share price has gone nowhere in the last 5 years. It just shows you effectively the upside opportunity. And I'm with you in terms of the big picture for oil, because I think what we've seen, the other angle of it, what we've seen over the last 18 months, is actually a level of discipline with OPEC, with Russia, and importantly with the swing producer, the US shale, because it hasn't yet turned on big production. And I actually think they'll reach a point where they'll increase capacity and distribution, because they can do quite quickly. But they're not going to do it willy-nilly at sort of like 50, 60, because they've been through that playbook, that move in. It's hit them hard. So what they're going to do is hold the supply and to sort of manage the price. Again, I think you're right. It's sort of like anywhere from 70 to 90 or even $100 per barrel.
You could see 100 on a shock. I think the other thing in the US where we talk about shale is that the institutional shareholders of these businesses, the public ones, which are the are the ones who will have the capital. They're not going to be allowed to go exploring and spending loads of money drilling into the ground. They will do some, but these companies are being run, as you say, for dividends now and for returns to shareholders. It's a bit like if you think back the miners are the same. They're running now very well, with a lot of capital discipline. And of course, you've got the environmental pressure on top as well about, how hard do you think it would be to open a huge new mine nowadays? It's going to be pretty tough. I mean,
it's like opening a new landfill, isn't it? It's just impossible.
Yeah, not in my backyard. Which I suppose then brings us on to things like nuclear, doesn't it? Just
before we go on to those, I would say, just if investors are interested, there's obviously the big integrated oils, but also have a look at some of the pure play gas producers,
like
because you've got Kistos in the North Sea, who are very, very cheap, and I know Andy Brough at Schroders likes them, and also Richard Penny at Crux likes them, and they're trading. I ran the numbers at around about sort of 15 times PE, but given the growth, and that's on old estimates at a lower gas price, and if you really want to go a bit sort of like offbeat but go into heavy sort of like gas, there's always Gazprom if you want to invest alongside Putin, but that's at 5 times PE, and they trade ADRs on the UK, so you can actually buy some, but obviously you've got to be happy and comfortable with investing alongside with a lot value going along with the Kremlin. And I would also say that if you really want to go a bit off the beaten track and go into the States, the US #1 pure play gas producer is a company called EQT, which produces more natural gas and LNG than likes of Exxon, Chevron, BP, and all these kind of guys. And that one is trading quite a reasonable sort of what was it? Yeah, I mean, single digits, PE multiples, admittedly on, sort of higher gas prices. But if you're positive on gas as using a transitionary fuel to more renewables, then these guys have got to play well. What about the oil services firms? Because that's again an interesting, hasn't yet come through the benefit of their numbers. But it's only a matter of time before, let's just say, for instance, the oil and gas guys decide to pull the trigger on extra production at $80 a barrel to, or $90 a barrel where we're heading. Then these guys are going to start seeing further activity like Wood Group, Schlumberger, and people like that.
Yeah. And if you've got $80 oil and you're running your assets harder, then the aftermarket, which is normally very profitable for these guys, will start to pick up a bit. It's quite interesting because, to be fair, these companies have tried to de-emphasize their oil and gas side, haven't they? Really, to quite a degree of late, and become much more renewables plays. But if the orders come in, then you need someone will have to provide the business. The question is the difficulty is at the moment what rating will the market put on those earnings? But if you listen to what Shell is saying that gas has to be a part of the energy solution, because where we sit at the moment, you haven't got anything else that can provide it. You need a technology change to be able to provide it, or some investment in some very long lead time assets.
And if people want to go into oil services, I would say have a look at Wood Group, because they came out as a soft first half, but they were seeing prospects pick up, and they're on a 10 times PE multiple. Admittedly, they've still got quite the higher level of indebtedness, but frankly, if that does start to pick up on the oil services, and they're into renewables as well. So let's turn to renewables. The effectively hydrogen.
Another little one there as well. The Warpaint Pressure Technology, which is into hydrogen, but it's also into oil and gas as well. And they are, as you say, waiting for the pickup to come through.
So it's definitely there's lots. They're cheap, aren't they? They're cheap. I can't remember about some 80p or something like that, and they haven't seen any benefit.
They've been over £1.
Okay, so let's turn our sort of lens to the hydrogen sector, which again sort of like really did very well sort of last year. It's sort of come off actually. But when you look at that sort of transition to 100% carbon-free fuels, and to be able to act as a store essentially of electricity from renewables, how do you see that sort of sector panning out?
It's a sector where there's a limited number of plays. So that's, I think, drove value. it drove stock prices to quite high levels. You know, you've got a lot of money going into ESG funds still, and they have, you know, how do they play hydrogen? Well, they've got a limited number. There's ITM, there's AFC. I mean,
there's Ceres as well, isn't there? They're the poster child.
Yeah, or you can play it through Linde and people like that, the huge companies. But they're the focus plays. But there's a limited number of plays there, and I think that drove the prices to kind of quite to high levels. What those companies, what people are starting to look for now is the earnings to start coming through from these companies. But you're seeing some big projects being announced. Shell, just talking about back to Shell again, they announced a huge project that's going to start construction in the next 12 months in Holland, in the Netherlands. That's the phase 2 of a project that's already up and running there. So it's going to start coming through in numbers, but that's what the market's looking for on those companies now. I mean, there's the adoption curve, isn't there, which you have in technology, where you get euphoria, where the price goes to the roof. Then you come back down to reality, and then you get the earnings coming through. So the share price goes up, down, and up again. Yeah. So I think probably in that sector, we're moving into, we're going through that kind of phase of it now, where everyone's bought into the idea that's brilliant. Then we've come back a bit because it's kind of, well, the discount rates come back because bond yields are going up, part of it. And now they're saying, come on, show us the money a bit, really, isn't it, really? Show us the orders, show us the revenue coming through. But there still is, as we just said, a limited number of plays. So these stocks, they can't be ignored because they've got technology. You know, they've got tie-ups, partnerships with big companies who would not have tied up with them if they hadn't got technology that's needed. They'd have seen through it. It was all just puff that would have been seen through. These are proper companies, proper technology that's needed in the hydrogen economy. So they should be looked at. The bit at the moment we're looking for is that revenue line to start motoring ahead.
Yeah, and I think just for sort of technology, I think just simplistically wise, ITM Power, they make sort of, I think it's electrolyzers which allow you to convert green electricity or renewable electricity from wind farms and from solar into hydrogen. And then you've got Ceres Power, effectively do the fuel cells that convert the hydrogen into electricity to better basically power things like, you know, sort of like cars and trucks and stuff like that. Well, they can
do boilers and everything, all that kind of market.
Yeah. And what else I know in hydrogen, they've got people a bit more downstream. You've got you sort of actually no, is it, yeah, I think no, actually, I'm talking about renewables, aren't I? Or no, nuclear actually. Nuclear. We've got sort of like
well, nuclear is the real kind of everyone hated it. Germany shut its nuclear power stations, which is looking like a major disaster because obviously they're now dependent on gas from Russia instead. It's all about base load, really, is the key thing here. And just to explain that quickly, in the electricity network, you have base load, then you have and at the top you have peaking load. The base load is what used to be provided in the UK by coal and nuclear. Now, obviously, coal's gone. You've still got nuclear, but these power stations are 10, 15, 20 years beyond their expected life. And you need to replace the base load because wind is brilliant, solar is brilliant, but you need the wind to blow and the sun to be out. And you can store it, but there isn't a market moving storage system at the moment. You can put batteries in, which is great, and but you can't have enough. You know, you'd have to have so many batteries for when the wind's not blowing. It's just not going to work. So that's where gas comes in as a solution. The 2 coal plants are back running again in the UK because they have to be. You haven't got enough wind. You know, look at a day like today: blue skies, no wind. Cold and no wind. So nuclear has to be part of the solution. The issue with nuclear is that it takes a long time to build nuclear power station. So the new idea here is distributed power, which are small, kind of put it on the back of a truck almost, and put it and to build, and Rolls-Royce are leaders in that kind of technology, along with a few other companies globally, where you can put it down and provide a solution. Now, of course, then you've got the NIMBY kind of, not in my backyard. Well, who wants a nuclear station at the end of your road? But the idea is these are much, much safer. They can use recycled uranium and whatever to actually power them, and they're much safer because they're smaller, etc., etc. But the one thing about nuclear is there's only a few companies in the world now that have got any skills and also, importantly, the authorizations to be able to deal in that market, because there's hardly been any new nuclear power stations built.
Yeah.
So I think it's an area that will come through. I don't think there's no real option really at the end of the day. The government in the UK are kind of coming around to it now that we need to do it. And I think there will be a premium paid for the companies involved in it. You see, Rolls-Royce has been moving up of late, and I think it's because they have been working on this distributed power, nuclear power, small units.
Yeah, it's amazing actually, because UK actually is a technology centre really now for nuclear development, both on the small form nuclear power stations like Rolls-Royce, but also actually on the decommissioning and the increasing the longevity with people like Avingtrans, because you know, they're sort of like integrated into Sellafield, which is the world's #1 decommissioning nuclear plant in the, you know, on the planet, and they came out actually with some prelims the other day, and actually the shares in the sell-off have actually dropped off, even though most people, because they're well cashed up, and I think the shares have actually, it's worth having a look actually for investors. That's ticker AVG, because you know, their shares have actually increased by 20% per annum over the last decade. And I think the CEOs, it's Steve McQuillan and Steve King, isn't it? I think
Steve. Yeah. I think that they're Hayward Tyler. That's done very well from the aftermarket, because if you've got a nuclear power station that's running 10, 20 years beyond its expected lifespan, you have to start replacing stuff. Yeah. So they will obviously be integral. And it's not going to be earnings that come through next year, but they will be earnings that there will be companies, and we know what the Avingtrans model is, the PI acronym there, that someone will want to buy that business off them for hopefully a very nice price, because they want to get into the nuclear market in due course.
Yeah, and they've well cashed up. It's worth having a look. So they've got 23 million pounds of net cash, and they're putting that to work in terms of future investments, both organically into their small form MRI scanner and into you know, potential M&A going forward. So that'd be one I would class as, you know, hold your winners and carry on with your winners. You know, don't sell those even though they've gone up pretty well. So we're just moving then to final sort of renewables. We've got sort of like Drax, we've got the wind turbine guys, things like Vestas, Saietta, who, you know, basically do axial flux electron. Do you want us to kick off with Drax?
Well, Drax is interesting because, I mean, it got hit yesterday because someone put a headline out saying it produces the most CO2 in the UK, but which is ridiculous. Basically, it burns renewable. It's wood pellets, isn't it? Wood pellets, yeah. So I think that has to have a place. I mean, they're looking for approvals to be able to burn more and produce more power, which would obviously be good news for them if that were to happen. We know in the UK there's a potential energy deficit. It's a renewable energy source. They need more emissions certificates to be able to do that, but they've got to be part of the solution, you would think. So I'm not an expert on Drax, but the environment looks good for them, doesn't it, really? And
they're on a PE of 8, and they're on a dividend yield of 4%. So as a large cap, it definitely looks a winner in the energy complex, with you know, obviously a self-funding model. And I would mention, actually, just looking at sort of that, you know, sort of the whole renewables, don't ignore somebody like Vestas, who they're the world's #1 you know, wind turbine manufacturer out in Denmark, because you know, it's quite a competitive space, but if nothing else, the energy problems we've had across the world has got to accelerate the whole adoption of onshore and particularly offshore wind. I did hear the president of Ireland saying that's the first thing he's going to do, is to have huge, big offshore wind farms, isn't it? And I mean, they're the only game in town, because unfortunately a lot of businesses and governments now don't trust Chinese technology because they're not sure the security angle to it. So they must be all. Another one is Saietta, which came onto the market actually in July, and about, I think it was £1.30, and they're now trading at about sort of 2.20. But they do these axial flux electric motors for 2 or 3 wheel scooters and for
I've seen.
Outboard boats and stuff like that, for marine and stuff like that. Now, they're again early days, but frankly, if they only get 5% of that market going forward, the shares are well worth sort of over £10. They have they've got unique technology which is patented. There aren't many people who've got these sort of like low cost, super efficient, small form, you know, axial flux types of motors. And I know they came out with a whole series of examples of just an update just recently on operational, and they're all moving in the you know, on the sort of the right path. So definitely something to keep your eye on.
EV, obviously, one thing that's going to happen with the oil price going up and the petrol price going up, and unique to the UK, the fact that you couldn't get petrol or diesel for a little while, is that EV sales are going, you know, interest in EV cars has gone through the roof as well. So.
Yeah, it has, hasn't it? Even though petrol versions and diesel versions have gone down, yeah. And the other thing on that EV side is don't ignore the copper miners, because there's one actually out in Spain that Richard Penny of Crux mentioned to me, Atalaya Mining, which is trading at a ridiculously low. I think it's like a 4 times PE multiple, admittedly onto the higher copper prices. And Freeport out in the States, you know, Freeport McMoran, the world's biggest, I think it is, you know, copper miner. So, you know, you've got to look at those, don't you know, because these EVs are going to need more copper in their, you know, in their cars, aren't they? So
we're moving to a global electronic economy, which is what we seem to be going to do.
Yeah.
And copper is at the heart of everything. So, yeah, totally.
Yeah. And then one sort of like, just moving off, then one sort of final sort of Brucey bonus last question for do you drive a DB5, drink vodka martinis, and looking to become the next 007 at all, Jamie? Because you do a good impression.
For what? Do I do what? Sorry,
do I do a very good impression of the next James Bond to take over from Daniel Craig, having just hung up his boots on No Time to Die.
I wish, yeah. No, I don't. I cycle around London, and that's about it for me. But yeah, I think it's that EV side, I think, will be interesting. One stock we shouldn't forget on that is Volex, of course, because they are the global leader providing the charging cables for the recharging cables for the cars. So, I mean, they're in with most of the manufacturers now, so OEMs now, so you shouldn't forget them as well.
Okay, well, brilliant. Well, thanks for your time, Jamie. We've covered a lot of material there. Lots of great ideas, actually, there for investors to pick through. And I think there's some really good value plays in there that should be good long-term investments. So look forward to hearing touching base in a month's time.
Okay, Paul. Brilliant. Good to speak to you. Thanks a lot.
Bye.
Bye.